It's time to take a closer look at how the trade war is really impacting the global economy. While most of the focus has been on the US-China relationship, the reality is much broader. This tariff war is touching every corner of the exporting world. When the US stops buying your goods, everything changes. Exporters are forced to reshuffle their trading partners, and the entire structure of global trade starts shifting. Trump's tariffs are projected to shrink global GDP by $1 trillion by 2030. This isn't just a skirmish, it's a major economic reshaping. Even within the US, the consequences are being felt hard. Consumers are losing momentum. The latest retail sales data speaks volumes. US retail sales declined by 0.9% in May, the sharpest drop of the year, and that came on top of a 0.1% decline in April. That means consumer spending is falling from an already weak baseline, showing that tariffs are having a real impact on the broader economy. And when the largest contributor to US GDP, consumer spending, starts to contract, it's time to sit up and pay attention. Prices are rising almost across the board. Chinese goods, now hit with up to 55% tariffs, cost more, and those costs inevitably get passed down to consumers. And it doesn't stop at toys or electronics. Remember those steel and aluminum tariffs? They're kicking in too. Slap on auto tariffs and the situation gets worse. Consumer budgets are feeling the squeeze. In April, the average new car in the US nearly hit $49,000, and that's just 2 months after steel tariffs were enforced. By May, the recommended retail price rose to almost $51,000. If trends continue, we could see prices reach $52,000 or even $53,000 by June. Right now, companies like Ford and GM are absorbing some of the cost to shield consumers, but that's not sustainable. For exporters who sell to the US, this is a red flag. Domestic consumption is weakening, and that means a demand collapse could be looming. And that's not even taking into account the potential return of Liberation Day tariffs under Trump's policies. Meanwhile, despite rising geopolitical tensions, including escalating conflict between Iran and Israel, the US dollar is weakening. This is a critical issue for global exporters. According to Bank of America, global fund managers are heavily shorting the dollar, with June short positions the highest since January 2005. Not even during the 2008 crisis were investors this bearish. It's clear that global exporters are rejecting the dollar, and for understandable reasons. Back then, even after the real estate collapse, the US economy had solid fundamentals. Wall Street needed help, but Main Street, especially tech companies, was still resilient. Bailouts made sense, and with a debt-to-GDP ratio of just 40%, the dollar remained fundamentally strong. Today, it's a different picture. The debt-to-GDP ratio is nearing 100%, making the US dollar a much riskier bet. If you're exporting to the US, you're now dealing with two major problems. First, trade volumes are dropping. Second, you're being pushed to realign with new growth centers: Europe, the Middle East, and especially Asia. These regions are driving future demand, and the US is losing trade share under Trump's trade regime. Trade between the US and Asia is expected to drop by over 2%, while China is set to gain about 0.5% in market share. And when China increases trade, it prefers not to transact in US dollars. The renminbi is increasingly the currency of choice, or alternatively, China is opting for local currencies: rupees, rubles, euros, depending on the trading partner. This shift, a form of de-dollarization, is accelerating. A major US bank has even sounded the alarm, reporting that exporters worldwide are actively rejecting the dollar for trade settlements. This is a serious challenge to the dollar's role as the world's reserve currency. Exporters no longer want to hold or transact in dollars because it no longer makes economic sense. The greenback is losing demand not only for US trade but for international trade too. Exporters are now requesting payments in euros, renminbi, pesos, and Canadian dollars. The reason is simple. Volatility in the dollar is threatening their already thin profit margins. Many exporters operate on margins of just 5 to 10%, and a 5 to 10% decline in the dollar can erase those entirely, or worse, put them in the red. This rejection of the dollar isn't driven by sanctions or politics, it's financial. A depreciating currency is too risky to hold. Despite global tensions, the dollar is down 9.4% this year, and it could fall even further. Exporters don't get paid immediately. Payment terms often stretch from 30 days to several months. If they invoice in dollars and the currency weakens further by the time payment arrives, they could take a serious hit. For many, exporting to the US could become a break-even or loss-making venture. And hedging against that risk isn't cheap either. What's even more telling is that it's not just exporters moving away from dollar settlements. Importers, too, are embracing alternatives. A Midwest lumber company, for instance, started converting its dollar cash holdings into euros before paying for European hardwood imports, just to take advantage of a 2% discount offered by the EU supplier for euro payments. This kind of shift was unthinkable a few years ago, yet now it's becoming the norm. Even US companies are being nudged into de-dollarization. The same is happening with Chinese imports. Chinese suppliers are demanding payments in renminbi and offering better terms in return. In short, the global trading landscape is transforming rapidly, and the dollar is no longer the automatic go-to for international trade. Between rising tariffs, weakening consumer demand, and a falling currency, the traditional structure of global trade is being re-engineered before our eyes. Trump's tariff war has set off a chain reaction that's rippling through the global economy in ways few fully understand yet. What began as a political maneuver is now pushing exporters and importers alike to rethink everything, especially their reliance on the US dollar. Exporters are moving away from the dollar to avoid being trapped in losses. Importers are chasing alternatives to secure better deals. The logic is simple, and the outcome is painfully clear. This isn't just a shift in behavior, it's a structural shift in global trade. And if the trend continues, it spells serious trouble for the United States. Around the world, more and more countries are trading in local currencies. The euro, not the dollar, has taken the lead, commanding roughly half of all international trade settlements. The dollar? It's fallen below 40%, and that's based on 2023 data. And we're not even at the tipping point yet. As China continues to push the renminbi into trade channels, the dollar's role is expected to shrink further. It's not a matter of if, it's a matter of when. And when that happens, there will be no shortage of efforts from figures like Scott Bessent and others to engineer some grand new strategy to prop up the dollar's dominance. But whether that will work is anyone's guess. Here's the cold truth. If fewer dollars are used in global trade, less money flows into US financial markets, including the all-important Treasury bond market. That's not a small problem. It strikes at the very foundation of America's financial system. And the response from central banks? It's loud and clear. They're stocking up on gold. Even with gold at record highs, up over 30% year-to-date, demand hasn't eased. In any other asset class, prices like these would scare off buyers. But gold isn't just another asset. It's more than a line on a chart. It's trust. It's security. It's something real that doesn't depend on the promises of politicians or the stability of Washington. A recent survey by the World Gold Council confirmed what's already playing out in the markets. Central banks are preparing for a future with a much smaller dollar footprint. When asked about their gold holdings, most central banks projected their reserves would be either moderately or significantly higher by 2025. And that's not a sudden impulse. It's part of a trend that's only been accelerating since 2022. Every year, gold demand rises, and every year, central banks quietly keep buying. That's the first part of the story. The second part? Even more telling. When those same central banks were asked about their holdings in US dollar assets, the response was almost the mirror opposite. Back in 2022, there was hesitation, maybe a bit of mistrust, but few were ready to pull out. Fast forward to today, and the tone has changed completely. About 45% of them now say they plan to reduce their dollar holdings moderately over the next 5 years. Another 28% say they're preparing for a significant reduction. That's nearly 3/4 of the world's central banks signaling a move away from the dollar. Let that sink in. Of course, this doesn't mean they'll dump all their dollars overnight. That would provoke a direct confrontation with Washington, and no one wants to feel the full force of the US diplomatic and economic machine. But even if the total dollar reserves grow in absolute terms, their share of global reserves is set to fall. And that matters, because when central bankers, the stewards of stability, start looking elsewhere, it signals a major change in global confidence. They're watching, like all of us are, how erratic the US has become. Politically, economically, militarily. The borrowing never stops. The threats of war are constant. And with each headline, each policy misstep, the world pays closer attention. These are not just economic decisions, they're survival instincts. And the world is no longer willing to bet everything on the stability of the US dollar. When asked what factors are driving their reserve decisions, central banks listed inflation, geopolitical risk, and yes, Trump's tariff war, as top concerns. These are not abstract fears. They are reasons to take action. That's why central banks are buying gold, not just once a year, but regularly, sometimes monthly. Gold has become the hedge against America's growing instability. US trade policy, fiscal indiscipline, and aggressive foreign strategy have created a toxic mix, leading to what many now believe is the slow but certain debasement of the dollar. So central banks face a stark choice. Other countries' debt instruments simply don't offer the liquidity that dollar assets do. Even the Eurozone doesn't have a debt market deep enough to absorb the shift. That leaves them caught between two paths: stay exposed to the risks of dollar-denominated assets, or buy gold and protect their value. And it's not just speculation. JP Morgan recently confirmed that the dollar remains significantly overvalued, even after its recent dip. The real effective exchange rate is still more than a standard deviation above the mean. Returning to historical norms could mean another 10 to 15% drop in the dollar index. Would that be a good time to buy? Maybe. Maybe not. It depends on whether the fundamentals of the US economy can recover. But central banks aren't waiting to find out. They're acting now, preparing for what could be an even bigger collapse. Trump's trade war has altered the trajectory of global economics. And if tensions escalate further, perhaps with Iran or elsewhere, there's no telling how fast this unraveling could accelerate. The world is reacting. It's preparing. It's moving. So here's the question. Can confidence in the dollar be restored? Will central banks keep stacking gold as the old system erodes? Or is this the beginning of a fundamental shift in global power and finance? Let me know what you think. Drop a comment, stay informed, and be sure to like and subscribe as we keep tracking this massive transformation. Stay safe out there. We're living through economic history in real time.